Hi students, I recently published the AFM pre-June 2026 mock exam. The answers for that, there were 3 videos. First video, the 50-mark question, then second video, section B, first question, third video, section B, second question, the last question. So there was one question where currency swaps was there. Couple of students have reached out to me asking to explain this currency swap a little more in detail. I saw even in the YouTube comments, one of you have mentioned elaborate currency swaps more. So purpose of this video, the first part of the video, I will just explain you how the currency swap works and what problem it solves, why it is done. Second part of the video, I will take another past exam question which includes currency swaps, currency options, the valuation of swaps. So we'll do all those calculations. Now, let's see the concept of it. What is this concept, currency swap? Now you see, let's say Steve Limited. Steve Limited is a company in USA. This company, they want to make an investment in another company, let's say in UK. In UK, they want to make an investment of 100 million pounds now. They will invest for 3 years. After 3 years, they will receive 200 million pounds. A simple investment like this, 100 million they are investing. After 3 years, it's doubled. They are getting it back. Now, the concern for this company, concern number one, they want this amount in pounds. So if they borrow in UK, they can get it in pounds. But you know, this is a USA company in USA. If they are going to make dollar borrowings, they will get favorable rates. They will get good rates because they are in USA. But if they want to make pound borrowings, they may not get that good rates. So this is their concern number one. We want to invest in UK. So if we borrow there, if we make pounds borrowings, then we may not get the best rates. Right. This is point number one. Point number two. Today you are investing 100 million and after 3 years you are getting 200 million. So after 3 years, when you get this 200 million, suppose if the exchange rates have moved unfavorably, if the exchange rates are too bad for you after 3 years, you may not be able to enjoy this full benefit. I mean, basic example, imagine today it's $1.25 per pound. So 100 million pounds means you're going to invest $125 million. Suppose after 3 years, if the exchange rate has gone down to, let's say, uh, 0.8 per pounds, worst case, it has moved too bad, $0.8 per pounds. So now when you exchange it, 200 million, 0.8, you get only dollars, 160 million. So in terms of pounds, it looks like doubled in the investment. The investment has doubled, but when you convert that to dollars, you invested 125 and you are getting only 160. It doesn't look that attractive when you convert. So this is the second issue. What is the second issue? If you are investing in a project at the project maturity point, when you get the return, if the exchange rates are not so favorable to you, if the exchange rates have moved unfavorably to you, then you may not be able to reap the full benefit from that investment. So, for these two together, we have a solution, which is the currency swaps. So, how currency swap will work? Now, Steve Limited will find another company in UK. Let's say ABC Limited. counterparty. Now, the first thing what Steve Limited will do, they will agree on an exchange rate. Okay, today's rate is 1.25. So what ABC Limited will do, from their bank, let me say bank A, ABC Limited's bank. From that bank, they will borrow 100 million pounds and they will give that to Steve Limited. So basically they have borrowed on behalf of Steve Limited. They are borrowing in their name only. ABC Limited makes a borrowing of 100 million. They are giving that to Steve. In return, Steve Limited, from their bank, they will borrow the equivalent amount. In the swap, they will agree a rate. Let's say the agreed rate is this $1.25 per pound. So 100 million pounds means $125 million. $125 million Steve Limited will borrow and they will give those funds to ABC Limited. Why can't Steve Limited directly borrow from a bank in UK? Why can't ABC Limited borrow from a dollar bank directly? Because they will not get the best rates. Because Steve Limited is a US company. They will get dollar rates good, but not the pounds borrowings. Same for ABC Limited. That is a UK based company. They will get pounds borrowings at good rates, but not dollar borrowings. So both of them are borrowing in currencies which are favorable to them. So they get the best rates, both of them, and then they swap those loans. Swap those loans at the agreed rate. So the requirement here, since Steve Limited requires pounds funding, that's why they got this pound, and they have to find another company, ABC Limited, which needs dollars as well. Otherwise, they will not agree for this. I mean, you can't just walk into a company and say, do you want dollars? So they must be in the need of dollars. So maybe they are looking to invest in USA. This is where a broker will come in the middle, an investment bank or a bank. They will play the middleman part, connecting these two. Then they will have a charge. When I do calculations, we'll see how to find the fees for them. So first step is this. Both of them are borrowing. Your company and the counterparty are borrowing at their best interest rates, at the currency that they can get best interest rates, and they are swapping the loan amount. Then during the loan, year 1, year 2, year 3, there will be some interest rate exchanges, interest rate swaps. Because Steve Limited, they have to pay this dollar loans interest. But the funds they are using is actually pounds. They are using ABC Limited's loans. ABC Limited, for their bank, they have to anyway pay interest for this pound borrowing. But the money they are using is dollars. The fund they are using is dollars. So there has to be some interest payment in between these two companies. Each year, there will be some interest swaps. Interest payments. In the calculation I'm going to do, I will show you all this in detail. And at the end, again, Steve Limited and ABC Limited. Now, Steve Limited invested 100 million pounds and they got 200 million pounds, right? Out of the 200 million pounds, now year 3 I have come to. You remember I said they are investing 100 and they are getting 200. Out of this 200, 100 million they will return. They will give it back to the ABC Limited. ABC Limited will take that money and they will pay their bank. Loan will be settled. How? From the project, Steve Limited anyway gets 200 million. 100 million will be used to settle the swap, currency swap. There will be another 100 million which they may have to go with the spot rate, or they can have some other hedging arrangement, whatever. At least 100 million is covered in the swap. So initially first step, ABC gave 100 million to Steve. After 3 years, Steve is giving that 100 million back to ABC. Similarly, ABC will give that 125 million they received at the beginning, dollars here, 125 million they received. Now from their project, they also invested somewhere for 3 years. They get the money back and give it to Steve. Steve will take that money and pay the bank. This is how the currency swap works. So there are three cash flows you need to remember. First one, initial capital swap. What is that? This one. This one. Each of them borrowing at their best rates and they are giving the capital to other, the initial capital. Two, each year interest swap. That I will explain more when I do the calculation. Three, reswap of the principal or capital. The initial amount, they are returning it. This is it. This is currency swap. And what are the advantages here? One, the companies, if they want to borrow in foreign currency, they may not get good rates. So in this method, each of the companies are borrowing at the best rates because they are borrowing in their local currency and then they are swapping it. Two, since you are re-swapping the amount at the end of the project at a pre-agreed rate, at least part of your end earnings are secured at a fixed rate, at a pre-agreed rate. So even if exchange rate fluctuates unfavorably to you, you are not exposing your full earnings to the risk. Clear? Done. Now let's go to the question. See, this is March-June 2017 question. This is from the Kaplan book I have taken. Buryecs Company is an international transport operator based in the Eurozone, which has been invited to take over a rail operating franchise in Virtonia, where the local currency is dollar. Previously, this franchise was run by a local operator in Virtonia, but its performance was unsatisfactory and government in Virtonia withdrew the franchise. Buryecs Company will pay $5,000 million for the rail franchise immediately. So this is the initial investment in dollars. Okay. See, Buryecs is in Eurozone. So their currency is euro. But now they have to invest in dollars. $5 billion they have to invest. Right. The government has stated B company should make an annual income from the franchise of 600 million in each of the next 3 years. At the end of the 3 years, the government of Virtonia has offered to buy the franchisee back for $7,500 million if no other operator can be found to take over the franchise. Today's spot exchange rates between euro and Virtonia dollars is this. Predicted inflation rates are given. Why do they give the inflation rates? So you can forecast the spot rates. Current spot rate is this. So use these inflation, purchasing power parity, and you can forecast the exchange rates. B company's finance director has contacted its bankers with a view to arranging a currency swap, since he believes that this will be the best way to manage financial risks associated with the franchise. The swap would be for the initial fee paid for the franchise with a swap of principal immediately and in 3 years time. So immediately you are swapping the amount and end of 3 years again you are re-swapping. Both these swaps being at today's spot rate. So initial swap as well as the re-swap at the end happens at today's spot rate. B company's bank would charge an annual fee of 0.5% in euro for arranging the swap. B company would take 60% of any benefit of the swap before deducting bank fees, but would then have to pay 60% of the bank fees. Okay, that we will see. Relevant borrowing rates. Eurozone. Eurozone, B company should have the lower rate. See, they can borrow at 4% because B company is already functioning in Eurozone. Whereas counterparty, it's in Virtonia, they can get euro dollars at 5.8%. Euro borrowings at 5.8%. Right. But Virtonia borrowing rates, counterparty gets a cheaper rate. Can you see? Virtonia bank rate plus 0.4. Whereas this company, if they want to go and borrow there, they will borrow at Virtonia bank rate plus 0.6. In order to provide B company's board with an alternative hedging method to consider, the FD, Finance Director, has obtained the following information about over-the-counter options in Virtonia from the bank. Exercise price quotation is in Virtonia dollar per euro. Premium is percentage of amount hedged, translated at today's spot rate. When I do calculations, I will explain all that. They have given you two options here. 7.75 exercise price, 7.25 exercise price, call option, put option. We have to decide. We will see at that point. Assume discount rate of 14%. Look, part A, first one, calculate the annual percentage interest saving which B company could make from using a currency swap compared with borrowing directly in Vertonia, demonstrating how the currency swap will work. 4 marks. This is a standard question you get in every currency swap question. This is the starting point of it. Right. So practice this really well. Any currency swap calculation comes, you will have this part. Calculate the annual I mean, they may word it differently, but same thing we will do it. How do we do this? Let me show you. Let's take a new sheet. Okay. Part A, first one. Right. So we'll take both companies' names. One is B company, Buryecs company. The other one, let's say counterparty. Yeah, okay. Let's say here counterparty. Right. Now you have a fixed rate borrowing and you have a variable rate borrowing. Take those two. Fixed rate. Fixed rate was given Eurozone. Or you can even name it Eurozone. Fine. We'll say Eurozone borrowing. If B company borrows 4.0%, counterparty borrows 5.8%. Other one, Vertonia. Vertonia borrows at, let's say, bank rate plus 0.6, BR plus 0.6%. Other one, BR, bank rate plus 0.4%, BR plus 0.4%. Now look at the process. First one, get the difference for each of them. When I say difference, you have to deduct in the same direction. Now you see, from here to here, I'm going to deduct it. Why? You have a bigger amount here, 5.8 here, you have 4% here, minus it, 5.8 minus 4, 1.8% difference. Correct? I'm not linking the formula, I'm manually calculating it because next one has letters in it, BR. So if we have calculated in this order, E column to C column, next one also you calculate in the same order. Same order. So here BR plus 0.4, here you have BR plus 0.6. So when you minus like this, you are going to get minus 0.2%. Why? BR, bank rate will be cancelled anyway. Here you have 0.4, here you have 0.6. 0.4 minus 0.6 is minus 0.2. Then you get difference of differences. Difference of difference. That means these two you have to minus. So first value minus second value. You get 2%. Minus it. Now let me explain to you what this logically means. What this means is B company, if they borrow at the best rate, which one they get the best rate? 4% Eurozone, that's the best one for them. So compared to counterparty, that gives them 1.8% saving. Correct? Similarly, counterparty, look at the other one, variable one, 0.6, 0.4. So counterparty, if they borrow at this, because it's cheaper for them, counterparty, variable rate is cheaper for them. So if they borrow at variable rate, compared to other companies' variable rate, they get 0.2% saving. So here 1.8 saving, here 0.2 saving, altogether 2. Total 2% saving will be there. So this is the total saving before any bank charges. Before any bank charges. How do we do it? Once again, you see, each type of loan, fixed rate loan or Eurozone loan, get the difference. When I say difference, from one column, you minus the other column. For the second type of loan, variable rate loan also, in the same order, you have done the first one, do it and get the answer. If it is minus, with the minus. Now, difference of differences, 1.8% minus minus 0.2 percentage. You know, minus minus makes it plus, so it becomes 2 percentage. Correct? Okay. Then, so let's say, let's give a name for this. What is this? Gain on currency swap. Gain on currency swap. And the question said, any gains, how these companies are sharing here. B company would take 60% of any benefit of the swap. 60% of any benefit of the swap. Okay. 60%. 2 into 60%. This company will take. 60% they will take. So counterparty will take the balance 40%. This multiplied by 40%. So if the overall saving is 2%, 1.2% saving should be given to B company, Buryecs company. 0.8% saving will be given to counterparty. This is through bargaining. This is not from any theory. Based on the size of the companies, based on the bargaining powers of these companies, they would decide this in their negotiation phase. Now let's include the bank charges. Bank charges. How much are the bank charges? See, bank would charge 0.5%. Also here they say would then have to pay 60% of the bank fees also. B company, they get 60% of benefits as well as they have to bear 60% of bank fees also. So bank fee altogether 0.5%. Same 60% for this. 0.5 into 60%. 0.5 into 40%. I should have put this with a minus sign because this is a gain. 2% is a gain. This is bank charges. Now I can say the net gain. Net gain on swap. Already minus is there. If you don't put the minus, now you minus it. Since I already put the minus, I'm just adding it. So the requirement they asked, see, calculate the annual percentage interest saving which Buryecs company could make from using the swap. This is the amount of saving. So let me write this here. Buryecs company makes a saving on its annual interest amounting to 0.9 percentage. 0.9 percentage. The counterparty will get 0.6 percentage. Okay. At the end, I will show you how this is going to be realized. I'll show you. Then, demonstrating how the currency swap will work. So, how this currency swap will work for you to understand. Now, you have B company, counterparty. Look at these differences. 1.8, 0.2. I'm just giving you the steps to answer the question. This is the bigger difference. 1.8 is a bigger difference. 1.8 is bigger difference. Who has that loan cheaper? Eurozone loan has the biggest difference. B company has it cheaper. B company has it cheaper. So, B company should borrow at 4%. This is the initial borrowing they are going to make. Correct, right? B company will make a Eurozone borrowing, their own currency borrowing. Then they will give it to counterparty. So, they borrow at this rate. Counterparty, then you give the other one. Counterparty will give the variable rate, because if B company has taken fixed rate, counterparty will get at variable rate because that is what is cheaper for them. 0.6, 0.4. So counterparty will borrow at this rate. This is the first step. And the second step, this is 1. 2. Counterparty wouldn't like to keep this variable rate with them. They want to take fixed rate. That is how the question background will be. They will not explain all this in the question. So what B should do now, B will pay BR, bank rate, to counterparty. So counterparty receives it. Counterparty receives it. Look at the diagram I will show you once again. B company, counterparty, B's bank, counterparty's bank. B has borrowed at 4% fixed. So they are paying to the bank 4%. Counterparty is going to pay to its bank rate plus 0.4. So this way both companies have borrowed at the best rates they can get. That was the purpose of the swap. Now B company will pay bank rate to counterparty. So that counterparty is released from the variable rate. Can you see? This BR they receive, this BR they pay bank rate, it's cancelled. From counterparty's point of view, it's cancelled. Correct? First step. So now automatically the bank rate is passed on to B company. B company is the one having the variable rate. Now ask the question, if B company directly borrowed at variable rate, they would have borrowed at this rate, BR plus 0.6. But we said they're going to have 0.9% saving, net gain. So from this original borrowing rate, if they should have 0.9% saving, what should be the final borrowing rate after the swap? Repeat, without the swap, if B company went on to borrow at variable rate, they would have borrowed at this rate, BR plus 0.6. Because that is what they can borrow in Vertonia, BR plus 0.6. They don't get fixed rate there. BR plus 0.6. But now we say, since you are doing the swap, you have 0.9% saving. From BR plus 0.6, if you minus this 0.9, BR plus 0.6 minus 0.9, your effective rate should be BR minus 0.3%. BR minus 0.3%. Now go back to the diagram and see, currently the B company is paying BR here and paying 4% here. As at now, they have BR plus 4. But I want BR minus 0.3. How this can be achieved? CP, counterparty, will give them 4.3. Where did I get 4.3 from? I want minus 0.3, guys. So I have to cancel this 4 and another 0.3 has to come in. Then it will be minus 0.3. First I have to cancel this 4 and then another 0.3 must be coming in because minus I have, not plus. So already BR is here, bank rate is going out. So I put another 4.3 coming in. So that comes as BR minus 0.3. The expected rate is achieved. I said this must be the net borrowing rate. Double check with counterparty. Now look at counterparty, how much is the borrowing rate they have. This BR cancelled. 0.4 is going out. 4.3 is going out. So they are going to get 4.7%. Effectively what they are paying is 4.7. Let's go back to the original working. Here. Okay, let's see. If counterparty borrowed at fixed rate, because they have to make a borrowing in the Eurozone, so they would have borrowed at 5.8%. But we say, oh, we missed the bank charges. I missed the bank in between. Just a second. Let's include the bank also here. So before this, let's have bank here. What is the bank? The one which is arranging the loan. So B company has to pay bank some fee. How much fee they are paying? Here 0.3% they are paying. 0.3. And counterparty has to pay 0.2 to the bank. 0.2 to the bank. Correct? Then counterparty to B company, how much they have to pay now? Look at the rates now once again. B company, BR 4.3 is there. Am I right? BR 4.3. Currently they have BR plus 4.3. I want it to be BR minus 0.3 because that's how we got the answer. Here it must be BR minus 0.3. So 4.6% has to be paid here. Check that 4.6%. Why? I need to give this 4%. I need to give this 0.3. Cancel these two, 4.3. Then give another 0.3 extra, then only it will become minus 4.3. Cancel this 4.3 and give another 0.3. So 4.6. Now look at counterparty. This BR they pay, this BR they receive, cancels. Everything else is payment. 0.4% payment. For the bank, 0.2% payment. And then you have 4.6% here. How much are they paying all together? 5.2% they are paying all together. Go back and see. If they borrowed directly, they would have borrowed at 5.8%. And we said they have a net gain of 0.6. From 5.8 minus this 0.6, you get 5.2% effective rate, net rate. So counterparty is happy. Why are they happy? They would have borrowed at 5.6%. Instead, now they get 5.2% net. B company is happy. Why? If they borrowed directly, they would have borrowed at Vertonia bank rate plus 0.6%. Now after bank charges and everything, they are getting at bank rate minus 0.3%. How did we achieve this? Look here. B company pays its bank 4%. Counterparty pays its bank BR plus 0.4%. First step. Then release this counterparty from bank rate. So B company gives bank rate to counterparty. Bank rate. Then one of these parties calculate the numbers, guys. Easy if you go with counterparty. Counterparty 5.8, we say saving 0.6. So 5.2 must be their net cost. Now check here. BR cancelled. 0.4 is here. 0.2 is here. They have only 0.6. So I put another 4.6. 0.6, 4.6 makes it 5.2. Their net borrowing. 4.6. So if they ask what are the steps here, this is what you're going to say. Let's say now coming back to the answer, this is first part you're answering, okay, this much, and all others I was explaining only. Now you continue the answer. You will say Buryecs counterparty. Okay, first we will say borrows at Buryecs borrows at what 4% we said. 4%. Counterparty borrows at bank rate plus 0.4%. Both of them get their best rates. Then we say Buryecs to counterparty. The bank rate is paid. So paying company keep it as plus, receiving company put it as minus. Bracket BR. So now counterparty, can you see I have removed the BR. This BR gets cancelled. Then counterparty to Buryecs. How much was it? 4.6%. So the paying company keep it plus, other one keep it minus. Minus 4.6 bracket my 4.6%. And there is some payment to the bank. Bank charge or bank fee. 0.3% was here. 0.2% was here. Then you can say net borrowing cost. Here BR is there. BR plus or not plus, minus 4.3, 4.6 minus. Do you understand? I'm getting the total of all these. You can't do with the formula. There is letters, so you have to do it, using your manual math. BR 4 minus 4.6 plus 3. So it's 0.3. And here BR cancelled. 0.4, 4.6 and 0.2, 5.2. You can justify further. Borrowing cost without swap. What would have been the borrowing cost without swap? Here they would have borrowed at BR plus 0.6% was given in the question. Here they would have borrowed at 5.8%. So the saving, net saving, you're just confirming your answer. See, BR plus 0.6, BR minus 0.3 plus 0.6 minus 0.3. How much is the difference? 0.9%. Here 5.8, 5.2, 0.6%. I took time to explain it. If you are doing it, you can do it within few minutes. Right, it might take like 5-6 minutes to finish this. Since I was explaining from the scratch, it took time. Yes? practice this. Definitely, if you are getting a currency swap question, you have this in it. You can't skip this. Now let's go to the part B. Evaluate using NPV the financial acceptability of B companies operating the rail franchise under the terms suggested by the government and calculate the gain or loss from using swap arrangement. Okay, so we are going to see one by one. Part A 2. Let's write down the cash flows. What are the cash flows you have? You are investing, let's say year 0, 1, 2, 3. 3-year project. You are investing in millions. So first we will do it in millions. Then we will convert to pounds or euros. Initial 5,000 million. Dollar millions. Minus 5,000. Then annual. They said 600. Did they say 600? 5,000 is the initial investment. 600 million each of the next 3 years. 600 million. Year 1 600, 600, 600. And then the year end maturity, or what you say, the government pays them, right? So let's say government payment. How much was it? 7,500 at the end. 7,500 million. Right. I need exchange rates to convert this. Exchange rates. So spot rate is given. Others I have to use the purchasing power parity and find it. Today's spot rate here. Okay, so it was given somewhere 0.143 euro per dollar. Word on your dollar is this much. Yes, 0.1430. That many euro per dollar. Okay. Let's keep it in 4 decimal places. Right. Then inflation. I need euro inflation on the top, dollar down, because see, euro per dollar. Euro inflation 6 and 3. Okay, this multiplied by 1.06, 1.03. Next, this multiplied by 4 and 8. 1.04 divided by 1.08. Next one, 3 and 11. This multiplied by 1.03 divided by 1.11. This is the exchange rates. Let me set all of them in 4 decimals. Done. Now the conversion, right? Swap initial amount at the current spot rate. Current spot rate. Okay. Then reswap. Out of this 7,500, only 5,000 will be covered in the reswap, right? So let me take 5,000 multiplied by today's exchange rate. Reswap happens at rate, today's rate. At the spot rate, see, this 600 is not covered in the hedging. Only the initial amount at the end 5,000 are covered. So this 6,000 will be at whatever the spot rate. Same for the other one also here. And last year, see this carefully. This 600, let me put in a bracket. This 600 plus, out of this 7,500, 5,000 was used for reswapping. There is another 2,500 balance. Correct? Or you can even take like this, out of this total you are earning. What is the total you are earning? 600 plus 7,500 you are earning in the last year. Out of that, 5,000 was used in reswap. The balance is open for the exchange rate. So whatever the exchange rate available on that day, this is the exchange rate available. Correct? Once again, you see, initially 5,000 you gave at today's spot rate, and that 5,000 you have to reswap at the end. So 715, same amount it will be, because same exchange rate, today's rate. Now this 600 at year 1 exchange rate, this 600 at year 2 exchange rate. Year 3 you have these two amounts received. Of these two amounts, 5,000 was used for the reswap to give it back to the counterparty. The balance amount I am using the spot rate. Done. So now you have in dollars. So net cash flow, not dollars, you have converted in euros, euro millions. This, let me use the sum function. These are the cash flows from the project with the swap. Find the NPV. NPV equal NPV. What is the rate they have used? 14%. Year 1 onwards the cash flow plus this. Please don't forget NPV formula in the final exam, right? Year 0 cash flow is not included in the NPV formula. So year 1 onwards all the cash flow should be selected, close the bracket, then add the year 0 cash flow separately. You get 185.64. Okay, this is with the swap. They asked, using NPV, financial acceptability of company, rail purchase under the terms suggested by the government of Virginia, and calculate the. Okay, so we have done this. This part looks good. We can say NPV is positive. Show you a skepticism. You say like if the exchange rate forecasts are reliable, if the inflation rates are reliable, if the cash flows are reliable, fine, it's acceptable. We can say that. What is this next part? Calculate the gain or loss in euro from using the swap arrangement. Now you see, if you did not go for the swap, no change in this. 5,000 you are just borrowing at this rate. Then year 1 no change, year 2 no change. Where is going to be the change? This reswap is not there. There is nothing called reswap. So either you can redo the whole calculation like this. Look here, I'm copying this. So here let's say with swap, right? Now same thing I'm going to do without swap. You don't have to do the whole working. I'll show you, what is the shortcut for it, but just to understand, without swap. Right, so you can now use a net cash flow at spot rate in dollar, in euro. 5,000 spot rate is this. Do the same thing for others also. Last year what happened? 5,000. Oh, okay. Let's use a sum function. All these cash flows. Okay, year 0, even though only one cash flow is there. So what I have done here, year 1 no change, year 2 no change, year 3 all this amount 8,100 all together I use the spot rate itself, because no swap, no hedging done. Now look at the cash flow. Without the swap you get 1,065. If you have done the swap, it would have been 1,123. Definitely swap looks better in this case. They're asking how much is the gain. So you can again go with the NPV formula, copy paste, and you see the difference. Gain with the swap. This minus this. Present value of gain is this. So this amount you could have easily done directly also like this. How? Look at the cash flow. See, 5,000, we go through the swap is the difference, right? So that 5,000, if you don't swap, how much difference does it make? If you are swapping, this is the exchange rate you are using. If you are not swapping, you will use the year-end exchange rate. So this is the cash flow difference at the year 5. Year 1, year 0, 2, 3, no difference. Only year 5, this reswap line is the difference. When you have swap arrangement, you have reswap at the original rate itself. If you don't have swap, you don't have anything. So swap rate, spot rate, difference for this 5,000, and I have to get the present value of this 14%. Year 3, use the PV factor or use the formula 1 plus 14% to the power of 3, 38.81. See, easy option. I mean, if you find this explanation confusing, go with the recalculation. Everything takes together. Last year, there is nothing called reswap. Again, see, last year, what did I do? Out of the 8,100, if it is swap arrangement, 5,000 I used using the initial spot rate because reswapping. The balance amount I used at the year 3 spot rate. If there is no swap arrangement, all the amount you will use the spot rate. Here, all the amount at the spot rate. That will be the only one making the difference. So you will do the writing part. I'm not spending time on that. You will do the writing part. Make sure you show the skepticism to get the professional marks. Definitely you will get some professional marks for the usage of formulas and all. Then skepticism you have to show here. Next part. Calculate the results of hedging the receipt of 7,500 million using currency options and discuss whether currency options would be a better method of hedging this receipt than the currency swap. What is the currency option data you have here? This one. Let me take this. Let's take a new page. Okay. Now you see, you have two options here, put options and call option. What is this company's issue? This is a Eurozone company. They are investing in dollars, return your dollars. So after 3 years, they receive $7,500 million. Do they want to keep these dollars? No, they don't want to keep these dollars. They want to sell these dollars and they want to convert it to their own currency. So what is their requirement? They want to sell dollar. When they get these dollars after 3 years, when government pays them $7,500 million, they don't want to keep these dollars with them. They want to convert this to euro. Want to sell dollars. Sell dollars, you need put option, not call option. Out. So this is the first thing you have to choose. So explain. The company receives dollars, but its own currency is euro. So they will need to sell the dollars. Put options are relevant. Now let's take these options one by one. 7.75. This is what? Dollar per euro. Dollar per euro. Okay. See here. After 5 years, after 3 years, right? In order to provide with an alternative hedging method to consider, the FD has obtained the following information about the over-the-counter options from the company's bank. The exercise price quotation is this, and this is the premium they have to pay. We will see the premium also. Calculate the results of hedging the receipt of 7,500. Only this 7,500 they are talking about, no other cash flows. This is what I was searching for. Only this 7,500. Okay. So, if unhedged, what happens? 7,500 million you receive, and what is the spot rate? Spot rate is this 0.01315. You will get this much. This many euro million you will get. Correct? Okay. Now, with the currency swap, how much will you get? I already have written it somewhere. We'll recalculate. 5,000 will be reswapped at the original exchange rate. This is the original exchange rate plus, where are we? Plus The balance out of 7,500, 5,000 you have reswapped. The balance at the spot rate, market rate. What is the market rate? This one. So you will get 1043.1575. Let's round it to the whole number. So definitely already we have concluded this. Compared to going unhedged, currency swap looks better. Now options. Currency options. Let's take one by one. First one, $7.75 per euro. 7.75. First one. $7.75 per euro. So what will happen? You look at the spot rate. What is the spot rate? Spot rate we calculated. It's here. After 3 years, what's the spot rate? This is the spot rate. But this is, remember, euro per dollar. Euro per dollar. But the option is given dollar per euro. So convert this. How? 1 divided by this. Get the inverse. 1 upon this. 7.60 dollar per euro. Dollar per euro. So see, this is the spot rate. According to the spot rate, you can pay $7.6 and you can buy 1 euro, because you want to sell dollars and buy euros, right? So to buy 1 euro per euro, to buy 1 euro, you have to pay $7.6 if the spot rate. If you go with the option, you have to pay a bigger price to buy dollars, $7.75 to buy euro. To buy euro, you are paying bigger dollar, bigger price. So is it worthy to exercise the option? No. Repeat, spot rate, market rate looks, for each euro you want to buy, you will pay $7.6. If you exercise the option, $7.75 you have to pay to buy each euro. Not worth it. So we'll say spot rate is better than the option exercise price. Option will be lapsed. You will not use the option. So what will be the net receipt to you? Net receipt. So you are going to use the spot rate, right? 7,500 million. You are using the spot rate. This, but remember, you already entered into the option. At the beginning of 3 years, you already entered into the option. So when you are entering into the option, you would have paid the premium minus premium. How much is the premium? This is which 7.75 option. Look at the premium. 7.75 option. 2.8%. They say premium is percentage of the amount hedged translated in today's spot rate. So they would have paid the premium 2.8%. Sorry, put option we need, right? 1.6 here, put option, not call option. We need put option. 1.6% premium they would have paid. So how do you find the premium? You take the amount you are hedging, which is 7.5 million or 7,500 million, 1.6%. 1.6%. This answer will be in dollars. I already converted this to euro. So in what rate? They said today's spot rate. Today's spot rate how much? Today's spot rate is multiply. Today's spot rate is this 0.1430. Repeat, guys. This is spot exchange rate you are exchanging. But don't forget, you would have paid a premium when you entered into the option contract. Premium is 1.6% of the amount. 7,500 into 1.6%. At spot rate, I'm converting it. I'm minusing that. That's a payment. This many euro. This looks very bad, right? Okay. Now the other option. Second option. 7.25 option. 7.25 option. Okay, look at the spot rate. Spot rate is the same as earlier. $7.604 you have to pay to buy each euro. But if you use the option, you can buy euro at $7.25 only. Option looks better. Options will be exercised. because euros look cheaper. You give less dollars to buy the euro. Options will be exercised. So how much will you receive? Net receipt $7,500 million. You're going to use the option, so divide by 7.25. So this will be the euros minus the premium you paid. 7,500 multiplied by, what is the premium price? 2.7%. This is at the initial spot rate. I have it here. 1,005 you are receiving, or 1,006. Still, currency swap looks better. See, with the currency swap, you are getting 1,044. Correct? So, whichever the option you are taking, it is not as worthy as currency swap. That's what they asked. Calculate the results of hedging the receipt 7,500 using the currency options and discuss whether currency options would be a better method of hedging this receipt than currency swap. So what is currency option? At the end of 3 years, you have an option to convert at the agreed rate. It's an option. It's not must. So in the first case, we saw the spot rate looks better. Then we would say, okay, we don't want this option. However, initially you paid a premium. That is a cost to you. That cost you had a minus. In the second case, option looks better. Second case, option looks better than the spot rate. So you would exercise, you would use the option. Still, I mean, this gives you a better result than going unhedged. See here, unhedged gives you 986 million. This gives you 1,005 even after the option fee, option premium you have paid. Option looks better than being unhedged, but it is not as good as currency swap in this example. Not always in this example based on these numbers. So that is the conclusion you will write. Clear? Good. Practice well. I wish you all the best for the exam. Do well, and after the exam, please give me the feedback how the exam had been. I'll be happy to hear from you. Thank you, guys.